Oh, okay. Hey, Kenny, good to see you. How are you?
I'm doing great, Darshan. How are you doing?
I'm well. Just so you know, LinkedIn is giving us problems, so that's why we're having issues. But we'll see if we can get onto LinkedIn eventually. But today's conversation is about the managed care industry and how amazingly well it's doing, and how Trump is a huge fan of them, and how things are going overall. So give me a quick
You know,
update. What's your
it's
take?
early, but have you been drinking already?
That's how you know it's the good stuff. You can't wait
It's-
till it's Friday night.
yeah. So at the bottom of my little picture there, it says Alliant MCIG. That's Managed Care Industry Group. That's so just in case anybody knows that I'm just like some bozo off the street to talk about managed care. I've
Yeah, you
got
want to tell us a
40
little bit about
years.
yourself before we do that, by
Yeah,
the
I
way?
got 40 years into this industry. I spent the first 30 of it representing managed care companies in court and in regulatory matters on basically whatever they could find themselves involved in. And then the last 12 years as a consultant for their risk. Not the things that they sell so much as the things that they buy. Their risk financing for their E&O. Some part of risk financing is risk transfer, which most people think of as buying insurance. Risk financing includes a whole lot of stuff that's not buying insurance, and we consult with managed care industries of all shapes, sizes, structures, strategies on their risk of doing business and how
Okay,
best to finance for that.
none of that makes sense. Tell me what that means. I've never heard of the term risk financing. When you said it's a whole lot of
Okay,
stuff, what does
so
that actually mean? Yeah.
yeah, so in terms of any business, no matter what the business is, all businesses have risk associated with doing that business. It could be a property risk, your house burning down, for instance, is a risk of owning a home.
Yeah.
Uh, People tripping and falling in the aisles of a grocery store or in the parking lot, sexual assault on the premises, injuries caused by criminal activity on the premises. Um, you've got issues related to people driving cars that are associated with you, or flying airplanes or helicopters or anything like that. People that have boilers. I live in South Florida, so we don't have those. But if you had one in the Northeast, then they blow up, they cause problems, etc. Then you have what we refer to as management liability risk, which would be considered directors and officers' risk of running the business, whether it's publicly traded, PE backed, venture capital backed, or just privately held. Then you've got employee liability things, fiduciary infidelity, risk associated with that. You have E&O risk, which is errors and omissions, which is typically a third party risk for liability purposes. Think of it as medical malpractice or pharmacy malpractice, or, everything from a regulatory action brought by the government to anti-competitive, antitrust litigation, personal injury, those kind of things. And then you have cyber or IT security and privacy risk. So all of these things, businesses, and particularly in healthcare, have, and they're all have to be built into the cost of doing business. Thus, the risk financing. You have to finance for that risk. The risk is there. Um, let's take an extreme example, asteroids. If you get hit by an asteroid, first thing is to identify the risk, which is, okay, is there a possibility that we get hit by an asteroid? Well, yeah, there is. So, okay, we've identified the risk. Then we quantify the risk. What is the likelihood that we're going to be struck by an asteroid? And two, what is the potential exposure or cost of being struck by an asteroid? Third thing in that little timeline is mitigate the risk. What can we do to prevent ourselves being struck by an asteroid, or to limit the damage if we are struck by an asteroid? Then you go to financing, which is how do we pay for the costs of the risk? If it happens and there is a loss, how do we cover that? We can self-fund it. We can transfer it to a third party. We could have a captive insurance company. We could have alternative risk financing through private means. It can just be carried as a balance sheet item. There's a lot of different ways of skinning the cat. One of the tools in the toolbox is buying insurance for that. I mean, some of that is very simple, like buying auto insurance because you drive a car. That might be required by statute. It might be required by contract, or it may just be a good idea because, to refer to it as legalized gambling is oversimplification, but it sort of is, because, you're betting a cost against a outcome. So if you spent, and I'm going to use ridiculous numbers, but I mean, if you spent $100 a month, for insurance, that's $1,200 a year, or in 10 years, that's $12,000. Well, if your expected return over that 10-year period is more than $12,000, then you're better off buying the insurance. But if you could take the $12,000 over time, because it wouldn't be 12 grand to start with, it would be $100 a month, and invest that in a different way, then you could end up with more money than you would have otherwise. So you're betting against the risk. Am I going to spend more money on the insurance than on the recovery? A great example of that is disability insurance. Knock on wood, I've had disability insurance my entire professional career. I wouldn't want to tell you, and I don't want to add it up, the amount of money that I have spent on disability insurance in 40 years. Fortunately, I have never been disabled. And therefore, all of the money that I have spent on those premiums is gone to me. But had I been disabled, the paying the cost of the premium would have been a much better, deal than not. So you're sort of betting against yourself. Do I buy the insurance? Do I not buy the insurance? And like I said, in many cases, it's required. It's either board required because it's a good idea, oversight requirements, et cetera, or it's contractual required, or it's governmentally required, particularly in healthcare.
So we're talking about healthcare. We're talking about the big updates that are happening. The big thing I'm seeing is this push towards transparency. There was a recent push. What is your take on this push towards transparency? Do you think we have enough, or do you think people just don't know about it? What's your take?
So when the No Surprise Act was passed, which was passed, by the way, on a voice vote at like 1:00 in the morning on the 23rd of December, literally, as part of a much bigger package, the concept was transparency. We're going to make the providers provide a whole bunch of information with regard to a certain number of procedures that they perform. We're going to make the managed care companies do the same thing, and then we're going to have this deal. The only people who ever pay any attention whatsoever to the transparency part, and quite frankly, most of the hospitals for years didn't actually even comply. They were being forced to comply finally. Managed care companies weren't a lot better, but they had the data, so that was easier for them to do it. But the only people that pay any attention to that are people who cull data and mine data and use the data for whatever it is they're selling as their products and services, or the government. Consumers, even though if you could probably have access to it, you wouldn't understand any of it.
Right.
So it's useless to you. Now, whether you can go on your website for your health plan, be it self-funded through your employer or whether it's an ACA thing or Medicare or whatever, and that you can go online, should you be savvy enough to do that, and compare costs, yeah, maybe. But most people in healthcare as a consumer don't do that. So transparency is a great word. It does provide a lot of information back and forth between the segments in the industry, but it doesn't have a whole lot to do with what consumers do or don't do. So when you look at the effort now or the lip service being paid to, we don't want subsidies in the ACA, we want to give people money directly so that they can have, a say in their health care. The question is the general public savvy enough to make that work? Going back to our pre-recording part about millennials, they will research forever, whether or not this pot or that pot is better for making pasta. That's what they do. But when it comes to healthcare, they either don't go to the doctor at all, or they just do whatever it is that the doctor told them to do. It doesn't translate for some reason. And you would think it would, but it doesn't. And if they're not doing it and they're the most tech savvy people out there, then your grandmother isn't going to do it. So it's having people give you money, having the government collect taxes and then refunding some of that money for you to use towards your health care, similar to an HSA that you would get through your employer. Does it help? Yes, but is it going to have the desired outcome of lowering costs? And in my opinion, the answer to that is no, because the consumers don't have I don't want to say they're stupid. Stupidity means, that you're not capable of learning. Ignorant means that you don't know. And most of us are ignorant of what we would need to know in order to make that work.
So I have a comment about that, because in the pharmaceutical world, there's something called the Sunshine Act. Have you ever heard of it?
Yep.
Okay, cool. So in the Sunshine Act, the idea was we're going to disclose payments made to doctors, and that's going to cause this downward pressure because doctors are going to take less money and blah, blah, blah. I don't think any of that happened. So it's the same point you're making, which is this transparency. Who is it really for? My first question to you is, who does the government think would exert that downward pressure? Is it employers? Is it individuals who are part of the insurance? Where would this downward pressure come from that theoretically it would cause a lowering of costs?
Well, in Economics 101, they would tell you that it's the consumer, because the consumer,
there's no choice.
But in today's world, where the largest consumer is the government, then unfortunately it's got to come from the government. But the historical nature of economics and finance and healthcare included in this country, particularly since World War II, has been government driven. Then the problem is that government policy has often had an equal and opposite reaction to what it was intended to do. Take subsidies, for instance. You subsidize the price of milk because you think that we need to have dairy farmers because milk is something that we need. Then you price support the milk. The milk becomes more expensive. It doesn't become less expensive. Same thing with subsidizing healthcare through Medicare, through Medicaid, through the ACA, et cetera. Is it a good idea to provide health care for seniors and poor people? Yes. It's a government policy idea. That's a great idea. But when you do that, you increase the cost of the services that are being provided for them, because the whole law of supply and demand is you're increasing the demand and that increases the cost. I mean, if nobody wants to buy your Cadillac, then the Cadillacs will be cheap. If everybody wants a Cadillac, then Cadillacs cost a lot of money.
I don't know if it's as simple as that, because there are value of scale.
It's never that simple. We don't, they teach this stuff for years, and we got 30 minutes. So yes, it was simple.
Okay, fair enough. So you're giving the 101 version. Fair enough.
The very simple version is, if you take away the subsidies and you put the money in the hands of the individual, and the individual goes out and makes an informed decision that I'm going to go to Dr. Darshan and not to Dr. Kenny, because Dr. Darshan is cheaper, then Dr. Kenny is going to have to respond in one of two ways. Either be so much better than Dr. Darshan that people are willing to pay the price of going to Dr. Kenny, or I'll have to reduce my cost of doing, what I do in order to compete with Dr. Darshan, or
show better value, right? So it's not so much get better, but show better value, which could be two different things.
Correct. There's also the problem of supply. Here we don't have millions of doctors and pharmacists and ARMPs and CRNAs and those people. So there's a limited number of people. And obviously, when the labor market is small and in high demand, the cost that you can charge for your services goes up. You're doing something that a lot of people can't. A lot of people aren't licensed or educated to do, and there just aren't that many of you.
Right.
I mean, if you had 1,000 OBGYNs in Broward County, Florida, then it would, be cheaper to see an OBGYN than if there were, 500.
That's interesting, because to me that comes to a few different comments. So number one, let's take Broward County, Florida. Let's take OBGYNs. No one's actually paying cash for OBGYNs, or a very small percentage are actually paying cash for OBGYNs in Broward County, Florida. In which case, it's really the health insurance company that's saying, we're going to decide the rates for physicians in Broward County, Florida. I've never thought of this before, but are there market rates dependent on location, or is there sort of a standard rate that OBGYNs get paid? And I don't care if there are 15 of you in Broward County or there are 50 of you, we're just going to pay you whatever we think is the appropriate rate. And is that based on supply and demand?
Well, first of all, that suggests that one contracting party has a lot more leverage than the other, which isn't true.
I've always thought it was. The payer usually has more leverage in this scenario, I would have thought.
No.
At least it feels like it. Interesting.
But mainly because there's not an unlimited supply. I mean, by law, I have to have an adequate network. And by competition standards, because I'm competing against every other, healthcare plan out there, for membership, then I need to be able to keep my rates as low as I can so that I can have my premiums lower, my costs lower, et cetera, so that I can compete. And the providers understand that. And with a limited supply, then you can demand more and more and more. If you want the named hospital, in your area to be on your network, then you're going to have to negotiate with them for their rates, and their costs are going up and up and up. And I mean, what's the 7% inflation last year in healthcare costs?
Yeah, and I was going to get to that at some point, but hopefully if I get to it. But let's take that exact scenario. You want the main hospital in...
Yeah, but hold on real quick. The answer to the other question is yes, it is geographic. there are
Oh,
there are
is it?
differences from geography. Yeah.
Oh, I didn't realize that. I just learned something new. Thank you. No, but let's take that Broward County example, the main hospital. I'm thinking about Florida, about Philadelphia, and I'm going,
Okay.
the main hospital in Philadelphia, no such thing. We've got 4 different hospitals that we're choosing from, 4 different health systems we're choosing from. If you, Independence Blue Cross, which is one of the main insurers in our area, you, Independence Blue Cross, decide that you're going to only work with Jefferson and not Penn, good for you. But the fact is that you have the right to do that. And we as insurance, as people buying the insurance, we'll just have to figure out how we're going to deal with it. I've never thought
there's 2 things about that. One, you have to have appropriate coverage.
What does that mean here? Because that means something special.
Network adequacy rules and regs require health plans to have appropriate coverage in a geographic area for all services being provided, so all benefits. So if I've got one, if I'm in a small geography and there's
then you have no choices. You have to go with them.
You have to go with them. If you're in, Boston, then you've got, a choice of a number of. The problem is that you're competing with the rest of the health plan. So if I'm an employer and I'm signing up with you, or I'm an individual signing up with your Medicare Advantage plan or your ACA product, I'm going to look at what hospitals and doctors are on your network.
Are people really that well qualified to do that? I would argue it's the same thing like transparency.
HR departments are.
Are they really? Huh.
Oh, yeah.
I would not have seen that. And I would not have seen that with transparency either. I feel like it's one of those things, theoretically, that may be true. But really, what most people are going is, if you can keep my premium lower by an extra $200 and you have to take out one of the hospital systems, I'll deal with that.
Well, that works well until you need that other hospital, or somebody else comes in and markets their plan over yours because they have access to all of the hospitals. One of the things that the Blue Cross Blue Shield companies were so good at is that they historically contracted with far larger networks than other health plans. So when you went into a Blue Cross Blue Shield geography, their list of network providers was much larger than a lot of others, historically speaking. So, they were, they had a leg up on things like that. But I mean, if you wanted a narrow network, so health plans started out as HMOs, health maintenance organizations, and those were typically narrow networks, meaning I only had certain numbers of physicians in every given specialty and a couple of hospitals, et cetera. And you had to go within that. And if it was a true HMO, there was no external benefit. If you went to a non-network hospital, it was all on your dime.
Right.
All right. Post ERISA, the law, that had to change, and you had to provide, benefits for urgent and emergent care out of network. And then you had changing, concepts. So you go from a PPO, a preferred provider organization, or an IPA, this alphabet soup forever, where the network model was different. So you'd have greater access. You now had out-of-network benefits and other things, so that you could appeal to employers, you could appeal to other people that are buying your services. Yes, generally speaking, it's much more expensive doing it that way because the cost of the network is going to be higher.
So I guess I think in terms of the PBMs of the world, they decided formulary. You have 15 different beta blockers. Yeah, we're not keeping all of them on formulary. We've got 2 of those, and we'll pay for those 2. Everything else is either completely off formulary, or there's a higher copay that goes along with it. And people.
Well, there's a reason behind that. Most of it's
exactly. But my point is exactly that. Theoretically, what you're saying is, if we apply the same logic to health insurance, you could you know what? There are 6 different hospital systems in this area. We're going to keep 2 on formulary and keep our costs low. The others will have as a backup, if you choose to go there, covered under ERISA, and that would drop and lower costs for everyone. Is that, am I wrong? Maybe I could be completely wrong with this.
Well, I mean, you're missing the piece of the puzzle that is driven by, I don't want to call it just marketing, but I mean, if I'm a commercial health plan or an MA plan, let's use Medicare Advantage for a second.
Sure.
So Medicare Advantage, you have multiple competing parts. You have traditional Medicare, which is run by the health plans, but administered by the government. You have MA, or Medicare Advantage, which has multiple players in it. The commercial health plans, of course. You have a whole bunch of not-for-profit or mutual health plans that are involved. You have a bunch of white-labeled entities that are listed as Darshan's MA plan, but Blue Cross, but IBX, Independence Blue Cross runs it for you. It's just marketed under your name, and then you have provider-owned health plans, whether or not it's a large physician group or whether it's a hospital or health system, where they run their own MA plan. So it's what we refer to as provider-owned managed care. So all of those individuals, all of those entities are competing for the same market. I'm competing to have people who are Medicare eligible sign up for my MA plan. So the finances, the mechanisms behind United Health Group's, purpose behind being in the MA market, and the process behind on the western side of your state, the University of Pittsburgh, UPMC, being in the marketplace are different. UPMC wants you to be on their MA plan because then you will go to UPMC physicians and UPMC hospitals, and therefore it's a revenue generator. They keep more money in-house. They can butter their own bread, so to speak. Not that it's bad. I'm not suggesting it's bad or anything. It's just the financial model. For United Health Group or IBX or that side of the state, it's Highmark or Capital Blue Cross, where those entities want you to be part of their MA plan because they're being paid just like anybody else through the government reimbursement, risk adjustment mechanisms, et cetera. And they are parsing out money to their in-network providers as care is delivered. So, they're not looking. And then, of course, with United, they've got both sides of the fence. But it's a different financial model, a different driver behind why you are doing what you're doing and what to do in order to be successful. But you have to compete with everybody else, not only in what you're offering to people that you want to sign up with your plan, but what you're going to offer to them in return. And that includes network availability and out-of-network benefits, and the advantage part, which is do you get dental? Do you get vision? Do you get to go to the gym? That's part of your MA plan. Do you have Part D or drug coverage with it? All of these are things that the marketplace, is competing against, and that goes directly to contracting. If you can come in and say, look, I'm only going to have, 5 OBGYNs in a given area, and they can cover my number of members. And I, got 2 hospitals in my geographic area, and they can cover my members. Right. And, I will have very limited out-of-network benefits. Then you can offer your product at probably a much lower premium. But how many people are going to buy it?
See, this is so fascinating to me because, again, as a consumer, I recognize for you as an industry that you're like, it's vastly more complicated than what you're saying, Darshan. And I'm kind of going, I just know that when I'm looking, I'm going, is my doctor covered? Yeah, maybe I have to move my doctor. You know what? If you can keep that doctor steady, I'll probably sign up. If you can keep my costs low, I'll probably sign up. And what you're saying is,
First two
yeah,
things I
maybe you
looked
will.
at. First two things, and this is my industry.
Yeah,
First
exactly.
two things I looked at every time, both when I had a decision and what plans we were buying,
Yeah,
because I was one of the owners of the business in the law firm,
right.
or currently when in our open enrollment is starting in 2 days, because our fiscal year runs from March to March. So, you know, it's the first two things I looked at when my kids were younger were, is my wife's OBGYN on the
Right.
plan, and are my kids pediatricians on the plan?
Right.
And
Right.
we would have options, and I could pick between, that's another thing. If you're got a sizable employer, most of the time you have a multiple options. You can pick the HMO, you can pick the high deductible plan, you can pick the this, you can pick the other, but you're making the decision as to how much money you want to spend in order to get what you want, as opposed to this is what you have.
Why is there no skinny option out there? Is there just no interest in it? Is that like what we just discussed? I'm calling it the skinny option, but yeah.
Well, I mean, ask the government.
Okay.
I mean, they
Okay.
passed the ACA, and that eliminated skinny options.
Okay.
I
I
mean,
just
it was dumb. I mean, great ideas in there, but the whole, I can't wait to pass it so we can tell what's in it. What was in it was not good in many cases, and it has increased rather than, oh, you're going to save $2,500, and if you want to keep your doctor, you can keep your doctor, and all that other muck that was said in order to get it passed. None of it is true. The costs have gone up incredibly
right.
since the ACA was passed, and you require health plans to pay for everything, and you keep adding things to them. I was on a call with CMS a month ago. I'm part of a group of people that consults with them on occasion when they have issues, and they were kind of looking into the, should we include IVF treatment as a required benefit? I'm going, please don't. Please, I get it. People want to have children, but IVF is expensive, and most of the time it doesn't work the first couple of times. And if you're going to require everyone else to pay so that Darshan can spend $150,000 to have a child, which is a voluntary thing to start with, it's just inappropriate. This isn't treating Darshan for cancer. This is, Darshan wants to have a baby, and I've heard testimony where people say that you can, by the way.
No, but this is not a conversation. We got to call it because we're well past time, honestly.
Yeah.
But I want to get into does health insurance have a social responsibility, i.e., we have population decreases going on in multiple countries. Should IVF or erectile dysfunction be covered not because it's voluntary, as you put it, but because there's a societal good that goes along with it, and or because there is a I've always described health insurance as people always go, why is Viagra covered but not birth control? And the way I've reconciled in my head, and I have no idea if it's true or not,
But birth
but
control is covered.
well, no, that's true too. But in the past, the way it was reconciled was, one is to make your body keep working properly. The other is to stop your body from doing something it's already doing. So, and I'm not sure that's necessarily true. I just sort of, that made logical sense to me. But now we're getting into a place where I go, IVF should be covered because it's not working properly. And
so now you've I want to say transgressed, but you've transitioned from economics to is this a moral imperative or
Right,
not?
right. We should discuss this in a
So
separate podcast, though.
it is healthcare a right? Is healthcare
Oh,
a
to be
privilege?
clear, I think it's a
Or
right.
is
Let me just
healthcare
put that out there. But yeah, moving
okay?
on.
But see, and I don't.
You disagree. I know.
But I mean, I don't think that it. That's another thing. But
Yeah.
I was going to take it back to the very first few minutes of this podcast, which was legalized gambling, the concept of risk transfer, risk financing, et cetera, because your health is a risk that you bear. Can you identify a risk to your health? Yes, you can. Can you quantify it? Yes, you can. Can you help mitigate it? Yes, you can. Can you finance for it? Yes, you should. Is one of those parts. Buying health insurance, risk transfer. Yes, it all fits directly into the box. It's the same set of factors. So the question is it more, are you betting against the house's money to pay for IVF versus not? Is it something that we should all pay for? Because, risk financing, risk transfer in particular is a risk pool. So should we make everybody else pay for Darshan to be able to have the ability to have a child? Sickle cell anemia drugs that just came out last year, with their $1 million a pop. Now they're supposed to work. Now, not that many people, thankfully, have sickle cell anemia. For those few people that do have sickle cell anemia, you think they want to be cured? Sure. Does an employer have an obligation to pay $1 million to cure you from sickle cell anemia? Realizing, of course, that is an impact to the entirety of the business. And if you're employed by GM that has, hundreds of thousands or a whole ton of employees, then $1 million or $2 or $3 or $4 million for that drug therapy for the people that have sickle cell anemia that are on your plan it's a cost, but it won't sink it. If you have 75 employees, then $1 million hit to the bottom line could
shut down the business.
Just shut down the business.
Yeah. Kenny, we need to stop because we can keep going. And this is honestly, we've had tons of these conversations. This one was very interesting to me. So thank you for doing this. We're gonna have to go back to the moral imperative one because I think that's a really interesting conversation. Thank you as always for coming on.
That reminds me of like a priest or rabbi, an imam all walk into a bar. Well, the imam doesn't. But I mean, why does Omar own a? Never mind. That there's a million ways to go, and government policy, unfortunately, is made at a much baser level than, is this a moral imperative and can we afford it?
Yeah.
Or should we? There's, and that's what drives most of this, unfortunately.
Thank you, Kenny. And for those people who want to reach Kenny and discuss moral imperatives, you can find him on LinkedIn. I will not give away his email address, though you should reach out to blah, blah, blah at kennywhite.com. I have no idea.
No, it's kenny.white@alliant.com. And no, I will not be discussing moral imperatives on LinkedIn.
Thank you, guys. Kenny, thank you so much for coming on.